Hello, I'm Robin, editor of Renew magazine. Welcome to today's webinar on Can Your Money Help Save the Planet? Before we begin, I'd like to acknowledge the traditional owners of the lands on which we're all meeting today and pay my respects to elders past, present and emerging. To start, a bit about Renew. Renew magazine is published by Renew, a not-for-profit organisation that inspires, enables and advocates for people to live sustainably in their homes and communities. The magazine's role in that is to provide practical advice on sustainable technologies and practices, something we've been doing for 40 years, since 1980. As an example, our most recent issue, our 151st issue, includes 2 articles that are buyer's guides, one on efficient hot water and one on electric bikes, both excellent ways to reduce your carbon footprint. That issue also includes an article on ethical investing, and that's what we're here to talk about today in our panel session. There'll be lots of opportunities to ask questions, though of course we may not be able to get through them all. Use the Q&A button to type in a question. If you have a technical issue, use the chat box to ask about that. Anyway, I'll pass you over to Sophie, the article's author, who's going to lead the discussion.
Thanks, Robin. Hi, everyone. Thanks for being here today. As Robin said, my name is Sophie Weiner. I'm a journalist at Renew magazine, and I'm really excited to present this webinar today on ethical investing, divestment, and shareholder advocacy. As Robin said, I wrote an article about this in Renew 151, which I will drop a link to in the chat so you can read it later on. So here with us on this panel today, we have Dan Gosher, the Director of Climate and Environment at the Australasian Centre for Corporate Responsibility, or ACCR, and Will van de Pol, the legal researcher and campaigner at Market Forces. So I wanted to get started by just asking Will and Dan to each tell us a little bit about what your organization does. So yeah, Will, do you want to start?
Yeah, thank you very much, Sophie. Market Forces is an affiliate project of Friends of the Earth Australia. So we're an environmental not-for-profit organisation that works to build community power to shift finance and investment away from projects and companies that would damage our natural environment, and instead shift that finance and investment towards environmentally sustainable opportunities. Obviously, a major focus for us is climate change and fossil fuel finance. So my role as asset management campaigner is to work with mostly super fund members to ensure that super funds are investing our money in a way that doesn't exacerbate climate change. So reducing investments in fossil fuel sectors, for example, and also working with the companies that they own to reduce their environmental impact.
Awesome. Thanks for that. Dan, do you want to tell us a little bit about ACCR?
Sure. Thanks, and hi everyone. Thanks Renew for putting on the webinar too, by the way. So ACCR is a research and shareholder advocacy organisation. And we work across a broad range of issues. So climate is one of them. I'm the Director of Climate and Environment. But we also work on labour rights and human rights. And full disclosure, I used to work with Will at Market Forces, so there's no secrets. So we do very similar work, with the exception that we look at a broader range of issues. But we believe that in the economic system that we live in, that companies have an immense amount of power over how we live our lives and how the natural world is, whether the natural world is protected or not. So we try to influence how those companies behave, and the way we do that is through whether that's filing shareholder proposals or whether it's engaging with the biggest investors in those companies, usually super funds, big global pension funds or large investment managers, and try to improve corporate behaviour through those conversations.
Awesome, thanks so much. So yeah, I want to get into some of the topics that we're going to talk about today. I just want to quickly remind everyone watching that if you have questions, you can use the Q&A button at the bottom of your screen, and we'll try to get to those at the end of the talk. So yeah, my first question is directed at Will. Your organization has done a lot of work on looking into what super funds invest in. But why should people care what their super funds invest in, and how do you believe that awareness around super funds investments can impact issues of corporate responsibility around climate change?
Well, I think there's probably two main points in response to that question. So from a purely personal viewpoint, I mean, I guess we all should care what our money is doing when it's not in our pocket. So when our super fund takes a cut of our paycheck and invest that on our behalf in companies, I guess it's incumbent upon us to understand what those investments are, what the companies that we're invested in are doing, and therefore, you know, what projects or operations our money is being used to help prop up. So there's the personal aspect, but then really importantly, I think from where Market Forces is coming from, the kind of work that we do, it's about understanding that as an institution, our super fund and super funds acting all together have massive power. So this group, I guess, of investors owns a significant proportion of the Australian Stock Exchange, for example. So all the companies that are listed on the Australian Stock Exchange have significant, the larger ones have significant investments from our super funds. And therefore our super funds have the ability to shift those companies individually and also shift the direction of the economy. So shift finance away from the companies that aren't transitioning to a low carbon future and really shut off the pipeline of money to those companies that are holding us back.
Great. Dan, do you have anything to add on this?
Sure. Well, primarily, Australians aren't particularly well. They're not particularly financially literate. So we're not really educated about superannuation when we're at school. You kind of learn about it once you get a job. It's like Will said, it's this 9 or 10% cut that goes into a fund that you don't really know a lot about. Most funds aren't particularly transparent, or a lot of funds aren't particularly transparent. There's a couple of good ones and a lot of bad ones. So you don't really know what your super is invested in, but you can hazard a guess or if you are in one of the good funds, they've got they do provide relatively good disclosure on their websites. But stepping back, I mean, we live in this economy, particularly in Australia, where a relatively small number of companies have or control quite a lot of the resources. So most of us would shop at Coles or Woolies every day. Most of us would be filling up our cars at 2 or 3 petrol stations that provide most of the fuel to the country. So they're just 2 examples, but so these companies control they're quite powerful, and if you're indifferent about your super, then you're indifferent about the way those companies operate and the way they, not just the way they treat the environment, but the way they treat their workers. Trying to encourage people to be engaged in super is like trying to I guess open their eyes to who's really pulling the strings around them. Where do they shop? Who's trashing the environmental places that they love? Do you really care about climate? And we'll get to that. And if you do care about climate, then the companies that are most responsible, how do you hold them accountable?
Yeah. Okay, great. I'd also just like to point out that there is a very good chart on Market Forces website, which breaks down the investments of various super funds and rates them by their alignment with the Paris Agreement. So I will be dropping that link in the chat for people to check out. Yeah, so following up, another question for Will, and Dan, please feel free to respond as well if you have anything to add. How does divestment help change company behavior? Is it more about hurting the company financially or sort of putting public pressure on them? And yeah, so that's my first question about this.
I think the answer is probably a little bit of both. Certainly over the long term, the divestment movement acts to restrict finance to particularly in fossil fuel sectors. So that's what we're seeing at the moment. As it gains a critical mass of large institutions that have put in place policies to not finance things like new coal mines or new coal power stations, those projects find it harder and harder to find the financial products that they need to get off the ground and continue operating. So, and that's not just, finance right at the outset to build a coal power station, for example. I think there's been a lot of movement in the insurance space lately, so that there are now quite a limited pool of insurers that will insure new coal-fired power stations, new coal mines, things like that. So there is, I guess, the restriction of finance and financial products that actively hurts those industries and restricts those products. But then there's also, as you said, it's kind of the broader statement about the kind of world in which we want to live and the kind of projects that we want to see pursuing and going forward. So, for example, if a major financier like Commonwealth Bank, if an institution like that comes out and says, well, we won't be financing coal past 2030, for example, that really sends a message that's heard across other financial institutions, but also politically and across the community as well. It sets kind of the parameters around the conversation as to how we are transitioning away from these polluting industries and into a more sustainable future.
Great. Yeah, I was going to ask, because I think sometimes people get a bit confused as far as divestment goes, whether it's sort of referring to your own investments and your own things that your money is in, or to sort of campaigns to pressure large institutions like banks and universities to change their investments. I was wondering if you could speak a little to that distinction.
Yeah, absolutely. And I think so, as I said, the main power, I guess, of divestment is when those large institutions are involved. Obviously, as I said from the outset, the personal decisions that everyone makes are important to set, to work to align your own finances with your values is an important step. But what I think is really important is all of us coming together and acting collectively to shift major institutions to sort of harness our consumer power, our power as super fund members or bank customers or insurance customers, to ensure that those larger institutions are the ones that are acting to join the divestment movement, I guess.
Dan, anything you want to add on these topics?
Yeah, look, I guess there's two reasons why you divest, and if we just limit the conversation just to shares in a company. So the two reasons you might divest, or there's probably multiple, but the two primary ones that we talk about are one, the ethical reason, because you don't agree with the company's behaviour, be there whether they're a coal miner or a tobacco company, for instance, or a company that makes weapons. And then the other reason is because you think there's an inherent risk in the company and that you're going to lose money. And much of the debate around divestment from fossil fuels for the last 5 to 10 years has focused on the first part. Is there an ethical reason why a large super fund should divest from fossil fuels? And typically the funds respond by saying, well, not all of our members agree with that proposition. They're all of our members have different moral frameworks, et cetera. And also the follow-up argument is that that they've got more power to remain by remaining as a shareholder to change the company. Now, we can get into that because that's, probably a whole webinar in itself. But if you go to the second point about, whether if they try to limit the risk, then, I know Market Forces put out some work the other day looking at the return on energy companies, so coal, oil and gas companies over the last 10 years. And it's terrible. They've underperformed the market for a decade. So really, is the argument around divestment to stay invested, or is it about actually protecting, your members' assets? Just on, the merits of divestment, and like I said, this is a really long conversation. I mean, and I suspect Will might agree with much of this, is that, we spend a lot of our time assuming that we can change these companies. And, I question that every day, whether or not we can. There are times, in history where companies have changed, but have they changed completely from being, an oil company to being something else? There might be one example of that happening in the entire world. So what we're asking this entire, fossil fuel industry to do is to become something else, or to cease to exist. And that is a very different proposition to say, asking a company to stop doing one single bad act, to pay their workers properly, or to, or to not pollute a single river. So it's the challenge of trying to change these companies is enormous. And like I said, I question it every day whether or not we can do it, as in we, collectively in the entire investment sector, and NGOs like us and Market Forces. But, you've got to try, right? Otherwise, because the only way divestment works is if everybody does it. So there's it's almost like there needs to be this critical mass of money flowing out of these companies in order for them to, for it to really hurt them. So yeah, I mean, I could go on, but I'm sure there are more questions to get through.
Thanks, Dan. Yeah, actually, my next question was going to sort of touch on some of what you were getting at. Obviously, you and Will may have somewhat differing thoughts on this, although I know you've worked together, so maybe your concepts are more similar than I would immediately expect. But yeah, I wanted to touch a bit on the arguments for staying invested in a problematic company so you can engage in shareholder activism versus divestment. I mean, I would love to hear if maybe those two concepts are not even as sort of opposed as we might think. And also, what are the drawbacks of each of those methods? And are there situations that, call for one of them where other situations call for another? I know that's a lot of questions, but if either of you has thoughts, which one of you wants to start, either way is cool. I don't know, Will?
Thanks, Dan, for nominating me to tackle this. At least I have a resource that I can draw on to answer this question. So Market Forces puts out a report each year. We've done it for the last couple of years, which basically looks at the 300 largest companies on the Australian Stock Exchange and identifies those within the top 300 that are actively undermining the climate goals of the Paris Agreement by expanding the fossil fuel sector or basing their business plans on scenarios that would doom the Paris Agreement to failure. So we've whittled down the ASX 300 to 22 companies that are continuing to expand fossil fuels after years of engagement. Their investors asking them to transition away from non-Paris aligned business models. And so for that small group of companies, we think the time is well and truly come for a divestment, particularly from our super funds. So we're running campaigns to get super funds to divest from that group of companies. Whereas for the rest, the vast majority, we think there is still some scope for working with those companies to transition to Paris-aligned business models. So, for example, that would be a large energy user, maybe Coles or Woolies that Dan's spoken about earlier, who isn't actively involved in the production of fossil fuels, but at the moment their business model needs to shift to ensure that they are contributing to the transition away from fossil fuels and towards a low carbon future by putting in place power purchasing agreements that focus on renewables, for example. So I think there is a large sector of the economy, the vast majority, that shareholder action and engagement is an appropriate way to try and get them to shift in the right direction. But there are some that, like Dan said, you're asking them to change their entire business models, and they either can't or they've demonstrated that they have no interest in doing that. And so that's where I think the divestment criteria is met.
Thanks. Dan, do you want to respond to that?
Webinars where people agree on everything are really boring, so I'm going to try and disagree with Will as much as I can. Look, the way divestment works is basically you sell the shares. If you're just on Will's previous point about if you're a bank and you lend money to fossil fuel, divestment really means, well, I suppose it means that you just stop lending to the types of companies, the coal and gas companies that are expanding production or trying to. So look, divestment is happening. There's no doubt about that. Not just at an individual level, but at an institutional level. Like just the other day, the Norwegian pension fund said it divested from AGL Energy, right? Because AGL Energy still sources 80% of its electricity from coal, and put BHP on watch. So big institutions around the world are divesting from fossil fuels. There's no hiding from that. And Australian funds are doing it too. They just don't talk about it as publicly. So if you kind of go through their holdings with a fine-tooth comb, you'll find that some funds just won't hold certain stocks because they think they're a bit risky. So it's happening. The risk of of divesting, of course, is that you potentially leave all of the shares in the hands of bad actors. And I know this is kind of playing devil's advocate, I guess, but if everybody dumped the coal company shares and they were just left in the hands of the few executives that are still working there, along with investors who still like investing in coal, then that company is just going to carry on as usual. And I know that's a bit of a cop out, but it has happened, and companies have been taken private, and so they can continue to operate without as much scrutiny as they had before. The thing that we are trying to push big super funds to do is, if they are going to stay invested in these companies, and prefer this engagement that they keep telling us about, then that has to be engagement with teeth. And what that means is, like, I completely agree with Will. There's a whole bunch of companies that are not aligned with the Paris Agreement, right? They have plans to expand production as much as they would like. The teeth bit comes in to say, well, okay, if you're not aligned, then they have tools to really kind of haul these companies into line. And the tools in Australia, at least, are to vote against directors. So every year, or every 3 years, the directors on companies are up for re-election. So, usually on each company, there might be 2 or 3 directors up for election each year. Like in other jurisdictions, they're up for election every year. In Australia, we also have this, the tool of voting against remuneration. Now, that seems like an odd thing to do, but if you vote against the remuneration report, or more than 25% of shareholders vote against remuneration 2 years in a row, then you can spill the entire board. So you can essentially remove the whole board if you wanted to. So if you believe that the board is responsible for the company's strategy, and that's the way companies are set up, then you've got to hold them accountable. So if the company's strategy is wrong, then they really should be voting against directors. So we are seeing that happen in the States to an extent. So at companies like Exxon, they've had some fairly big votes against directors in the last couple of years, and you saw it more recently at JP Morgan, the big US bank. There was a director on there who was the former CEO of an oil company, and they investors basically got rid of him. So there is like engagement. I think it can work if there's consequences, and unfortunately, we're just not seeing those consequences play out in Australia yet. So it's a live conversation, and we're trying to make it more forceful. But that's the challenge.
Great, thanks for that. Just want to remind everyone watching that if you have questions to ask, you can do so by clicking on the Q&A button at the bottom of your screen, and we'll get to them pretty soon. So sort of continuing on that subject, Dan, I know that ACCR has been involved in several recent campaigns at Woodside Petroleum and at Santos that were pretty successful in getting a large portion of shareholders to pressure the company to, you know, change their priorities in alignment with goals in the Paris Agreement. Can you tell me what it was like to organize those campaigns and why you think that they were so successful?
How much time we got? I've got to leave time for Will to talk about Rio as well. So look, we put the two same resolutions we put to both Santos and Woodside. So if you're not familiar with both of those companies, big gas companies, they don't have retail brands. They they extract gas, export most of it to Asia. And they've both been around for a long time. Woodside is based in WA and Santos is based in South Australia. And we've been engaging, or so as Market Forces, we've been engaging with both companies for 4 or 5 years. Both companies have plans to increase production significantly. Prior to the crash in oil prices, I think Santos was looking at a 60% increase in 5 years, and Woodside was looking at a 70% increase in 8 years, something like that. So as Will said, neither are aligned with the Paris Agreement. And, so this just didn't kind of happen overnight. It's the end, not the end. It's like the ongoing conversation that investors have been having with these companies for a long time. So the two resolutions we put to them, the first one was about setting targets. So scope 1, 2, and 3. So just quickly, the difference, I guess, or the key difference in that resolution is the scope 3 part. So scope 3 essentially incorporates the emissions from the gas that they sell to Asia. So up until this year, really, most companies and investors have been really pushing back against responsibility for those emissions. They say that the customers that buy the gas in China or Korea should be responsible for those emissions. And now investors are saying to the companies, well, no, actually, you've got a responsibility for those emissions too. And then the second resolution was around lobbying. So ACCR has done a lot of work on lobbying over the last 3 years. And the reason we focus on lobbying quite a bit is because we think climate is such a big problem, you're not going to get it, you're not going to solve it without government policy. And the barrier to good government policy is companies lobbying against policy. So, we engage with companies to try and get them to either stop, lobbying negatively or to start lobbying positively. And that's a real challenge. So if you're familiar with BHP, it's pretty much a member of, some of the worst lobby groups in the country, the Business Council and APPIA and the Minerals Council. So, we've been, talking to BHP about this for a long time. And, and essentially you start by asking them to do a review of their industry associations, and then you move to saying, well, that you're not aligned with these industry associations, so you should leave. So the resolutions with Santos and Woodside, the lobbying resolutions both got 40-something%. The targets resolution got 43% at Santos and just over 50% at Woodside. So it's the first resolution to get a majority support. Due to the terrible corpus law in Australia, they're not binding, even if it does pass. But what these resolutions do is that they act like a poll. So it's like doing a political poll. It's a poll of shareholders in the company, and you essentially got half your shareholders in Woodside saying that you need to rein in your plans to expand. Now, whether the company does that or not is we'll find out over the next kind of couple of years, I guess. But that's the challenge for us now. Is people have been kind of congratulating us, saying, oh, good work on the big votes. And for us, it's nice, but it's certainly not a victory, because the companies still have plans to open up new fields, right? So the work is now for us to convert those big votes and that shareholder support into, not necessarily winding these companies down, but at least kind of putting a halt on some of the expansion plans. That's the real challenge, because both companies have such big plans. Sorry, and I've probably gone too long on those two, but I know you're going to ask Will about Rio.
Will, do you want to explain that?
Well, I actually just want to follow up a little bit from the conversation we were having earlier. I think these resolutions, like the big votes at Santos and Woodside, if those companies then aren't shown to be changing, so if they're not reining in their production plans in line with that sort of demonstrated support of investors, then it then bolsters arguments for divestment. So investors can see that, well, we've tried engagement, we're pushing this company to do better, and it's not coming along for the ride. And I think that's a really good example of where the two strategies can work in tandem and sort of with the threat of divestment, perhaps the companies will shift. And if they don't shift, then the investors can pull their money out. So just a good example of how the two strategies can work together. We also had a resolution recently get strong support from investors. Had a resolution at Rio Tinto, again calling on the company to set scope 1, 2 and 3 emission reduction targets. And for Rio, its scope 3 emissions are when the customers of its iron ore use it to create steel, generally in China. So a really huge emissions profile of an industry that needs to come down in order for us to meet the Paris goals, but one that historically investors have said, well, no, that's not Rio and iron ore companies' responsibility to manage. And we were able to convince, I guess, about a third, 36 or 7% of Rio's shareholders that no, it is actually an issue that this company needs to take responsibility for and act to reduce those emissions over time.
Great, that's awesome. Okay, cool. So I guess my last question to two of you before we move on to questions from the audience. How can people who are watching this, who want to get involved in these various activist avenues, what would you tell them is the first thing they should do to get involved? And I will be dropping links to both of your websites in the chat. Dan, do you want to go first?
Sure. I guess there's two things. One is to engage with your super fund. A lot of people may not be able to move super funds. I know people in UniSuper, for instance, can't necessarily move funds, and same with Commonwealth Super Corp because they're public servants. So their EBA might be tied to a particular fund. What you can do, a lot of funds now have a sustainable or an ethical option. So they, which may or may not screen out fossil fuels. Probably best visit Market Forces site to see whether or not that's the case. And I've just responded to a question in the Q&A about the Ethical Advisors Co-op also has a list of ratings on which funds are invested in fossil fuels. The other thing you can do is become a shareholder. Now you don't have to, buy tens of thousands of dollars of shares, but in order to file shareholder resolutions, we need 100 shareholders. And I know we'll probably put up the same pitch. And finding those 100 individuals is a challenge, not necessarily for the big banks or your BHP and Rio Tintos, but for some of the smaller companies, it is a challenge. So, if you've got $500 spare or $1,000 spare, we're always looking for new shareholders to co-file resolutions. And I know my team is putting on a webinar about, what resolutions are and how they work next Wednesday, which is on our website. So if you're interested in that, you can check that out. But yeah, I guess they're the two things you can do: engage with your super and become a shareholder and support, our work and Market Forces work.
Great. Will?
Yeah, so leading on from Dan, if you want to get in touch with your super fund, you can first check out what it's invested in. As much as, there is limited disclosure and we're not always able to find out exactly where super funds are investing. We've tracked as much as possible Australian super funds investments in Australian shares, and that's at marketforces.org.au/superfunds. And you can do a little bit of background reading as well of our out of line, out of time report, which I was talking about earlier, which basically shows where those company classifications, I guess, come from. You can also, through the Market Forces website, compare your bank and see whether your bank is lending to fossil fuels and take action to contact your bank and get them to shift, as you can with your super fund and insurance companies, all this through the Market Forces website. And if you are interested, as Dan was talking about, in getting involved in the shareholder activism side of our work, I guess the best place to start is marketforces.org.au/get-involved. I can share that link because it's a bit of an annoying one. But that will take you through our shareholder activism program, and you're able to sign up and let us know which shares you own and see where our priorities are coming forward, so that you can get involved in that work as well.
Awesome. Cool. So we have about 20 minutes left. So I'm going to start getting into some of these questions that people have written. If people want to ask another question, you can put it in the Q&A button at the bottom of your screen. We probably won't be able to get to all of these questions, but we'll get to as many of them as we can. So first, and just Will and Dan, you can both respond to either of these. Whoever has, if you think you have a relevant answer, feel free to respond. So yeah, first I'm gonna ask a question from Peter D. He says, what do you say to people who are concerned that their retirement savings or general investments may perform poorly due to the more limited range of investment vehicles?
I'm going to jump in here if that's all right, because we actually just on Saturday released some analysis of the investment performance of pure play fossil fuel producers. So that's the companies that are, their only job is to produce coal, oil or gas. And so there's 11 of those type of companies in the top 300 companies in Australia. Over the last 10 years, those companies have underperformed the market considerably. I don't have the analysis right in front of me, but it basically shows that fossil fuels in the Australian economy sort of parted ways 10 years ago, and that trend has been, the gap in performance has been widening over the last 10 years. So while, I'm not here to give financial advice, and past performance is not an indicator of future performance, I think we can all agree that if we're going to meet the climate goals of the Paris Agreement, then the transition away from fossil fuels is only going to increase. So that, I guess, would be my response to that first question.
Great. All right. Well, I think I'm going to move on to another one. So Harry Otis, not sure if that's how you pronounce it, but from him, here's the question. He says, as the terrible record of the big four banks has shown, people are still reluctant to move to other banks. Why? What can we do to persuade people to move their funds rather than try to persuade the banks to do the right thing? Either of you?
Yeah, this is tough. I mean, the big four banks do have such a stranglehold on the Australian banking consumer group, I guess. What we do at Market Forces is just continually try to produce the information that would inform and empower people to make those decisions, to either engage with their bank and push them to do better, or make the decision to switch and make that in the most public way possible. So I think, how do we, I guess, help clear that barrier of the mass movement away from the banks? It's all about informing and empowering as many people to take that action as possible. And then when you do decide to take action, really making the most of it by making your decision public, doing it in a public way, and engaging as many other people in that decision as you possibly can.
Cool. Cool. Next up from Sherry. In addition to influencing against poor sustainable outcomes and holding boards to account, are you also promoting other sustainable investment alternatives?
I might have a crack at that, Will. I don't necessarily promote other funds or, so, I mean, within your own super fund, if they have an ethical or a sustainable option, I'd suggest you check it out. And if you think it's for you, then switch. But we don't go and promote, any other kind of, we don't anyway, that you should switch to this particular fund because it's the best fund. In terms of when we speak to companies, we encourage them to invest in renewables as much as they can. I have spoken to RE100. There's a corporate initiative called RE100, which tries to encourage companies to go 100% renewable. So we kind of feed into those conversations as well. And in recent years, you've got companies like Telstra, Aurora Group, which is a packaging company, signing fairly big PPAs. So that we do have those kinds of conversations. It's a much more challenging conversation to have that with an oil and gas company to suggest that they should be investing in renewables, because it's like speaking a foreign language to them. The one thing that they may do, and Santos has done to an extent, is they've put up small solar installations out in the Cooper Basin, for instance. So for the electricity they use on site, they'll switch from using a diesel generator to using solar power, but they're still using it to extract gas. So getting them to invest in large scale renewables that's a big challenge.
Okay. So from Sarah, what advice would you give to CEOs of insurance companies to take action on climate change, which she says is clearly an existential threat to them?
Yeah, the insurance campaign is one that Market Forces has been running, I think probably started by Dan when he was at Market Forces before now. And it's the existential threat is a good way to summarise exactly what's going on for insurance companies. On the one hand, they're investing in and insuring projects that are worsening global warming, and on the other hand, they're paying out on the impacts as that global warming impacts it as natural hazards or weather events. So yeah, we've been running a campaign for some time now to get those insurance companies to stop investing in and insuring fossil fuel projects and companies. It's having slow progress. I think we can all agree that the progress is not at the pace of change that we need to see to really shift the economy away from fossil fuels. But it's something that is an ongoing piece of work. Dan, probably got something to add from the insurance side.
Yeah, I mean, I've had I used to work for an insurance company, so I've had a few conversations with, some fairly senior insurance people. I think when Market Forces first started doing this work, I think there was still a bit of, I wouldn't call it denial, just, companies kind of underestimating how big a problem this was, and that it really is an existential thing for them because, insurance companies need to write insurance in order to exist. And if they can't write it because it's too expensive, in places like North Queensland because of, cyclones or floods, then they cease to have a business. So yeah, it is an existential problem. So the one thing we've continued to talk to insurance companies about is the lobbying aspect. So, most insurance companies are still members of groups like the Business Council, and the Business Council has lobbied against climate policy for as long as, for 20 years probably. So they're still funding that work, which kind of makes no sense. If climate is an existential problem for you and your business, then why are you funding someone who's standing in the way of good policy? So they're the kind of conversations we've had, and try to encourage CEOs to be more outspoken on climate. And I think in the last year or maybe 18 months, I think proves the success of Market Forces work is that, the CEOs of IEG, Insurance Australia Group, Suncorp and QBE have all come out publicly on the record on the need for action on climate, which 5 years ago you wouldn't have thought possible. So I think that's ultimately the insurance industry is up against the coal lobby, right? So that's the challenge. So, I once said to an insurance CEO, why is the coal industry so good at lobbying and you're not? And he laughed and he didn't have an answer. So I don't think much has changed, unfortunately.
Cool. So from Nick, improving disclosure laws would appear to help. Is this a realistic proposition? And if so, what would be the process for achieving this? I know that there has been some change in disclosure regulations around super funds. Maybe there's a wider question here as well. Either of you?
Yeah, there's been a really frustrating delay on mandatory disclosure laws for superannuation funds. So I think we're now talking like 8 years ago or something, these laws were recommended and actually, written into legislation that has been delayed as to when it would come into effect for, years and years now. But basically, there is legislation that would force super funds to disclose their investments, I think, on a every 6 months basis or something like that. And the latest delay had pushed that out from the end of this year to the end of next. And I think given the impacts of the coronavirus and regulators now having a different focus, I doubt that those regulations will come into effect in the near future. So very frustrating. I agree that more disclosure would obviously help to inform and educate a broader section of the public as to where super is invested and what they can do to avoid certain investments. So we'll continue to push for that, but we just haven't been able to overcome the pushback, I guess, from those players that don't want to be disclosing their investments.
Great.
Yeah, the disclosure thing is it's been around for 10 years, really. This so there was a review into the super system in 2010, and that review recommended disclosure of everything. Full fee structures, holdings, voting records, everything. And the industry's managed to push back against that legislation becoming, so essentially I think it's the Treasurer that's responsible, maybe the Financial Services Minister, has essentially kept pushing it back. I think it might be valid to come into effect at the 31st of December this year, but as happened last year, they pushed it out again in about October. So, and they've just keep kicking the can down the road. So some of the better funds see the benefits in transparency. The thing about super funds is they've become so big that in the absence of transparency, it's easy to criticize them. So they see transparency as in disclosing as much as they can as defense, I guess, from any criticism or attacks.
Okay, cool. So next up, a question from Baptiste. Is there scope to pressure Parliament to pass regulation to increase the accountabilities of corporate executives in Australia?
Well, yes, and I think there is already enough regulation and enough discussion around what executives and directors in particular actually need to do in order to discharge their duties. So I think not just is there scope to press for stronger regulation or legislation, but really we need to see what's currently there being exploited more and or enforced more to ensure that company directors in particular are managing climate change risks. So would love to see more legal action trying to enforce proper climate risk management from company directors, which, company directors do have a duty to manage risks on behalf of their shareholders and on behalf of the company. So while, more regulation and greater accountability there would be helpful, we should also be seeing more action from on the legislation that already exists.
Cool. So next up, it seems like my question may have disappeared.
Might have just replied to that one.
Oh, okay, cool. Got it.
Was that the one about energy Darwinism?
Possibly. Yeah, I think it was something like, do we need to be more clear that, you know, some companies may not be able to improve in the way that we would like?
Yeah. The short answer is yes. The harder part to that is that, you know, how do you tell an oil and gas company that you can't exist anymore? Like, you know, that's part of the problem here, right? So in the US, I know that conversation is kind of getting a bit of momentum that oil and gas companies should basically just return all of their cash to shareholders and, you know, essentially wind down over, you know, 10 or 20 years and not develop anything more. But that conversation is not really happening in Australia yet. I mean, I've tried to raise it, but it doesn't really get anywhere. It doesn't get anywhere. And then, you know, there are some companies, you know, look at companies like AGL and Origin, for instance, and these are some of the real problematic ones because, you know, they've got millions of retail customers. So there's no reason they can't be another company. You know, they could be another, you know, an electricity supplying company, but you've still got to get them to shut the coal-fired power stations down. So that's, you know, those two companies have the opportunity to be something else, to transition into something else, because, you know, there's always going to be a need for retail electricity. Or maybe not with solar panels, but that's another question. But they have the opportunity to become something else, whereas Santos and Woodside probably not. You know, and I think there's one company in Denmark that went from becoming an oil and gas company to becoming a wind company, an offshore wind company. But that's one example in the whole world. So, yeah, the prospects of them changing are not great.
I mean, that's interesting as a follow-up question. Obviously, you still find it valuable to engage with those companies. So I guess what is the goal there, just to, you know, sort of encourage them to have better, you know, functioning, even if ultimately they are probably not going to be part of, you know, a net zero carbon world?
It's a good question, because, you know, I think that's one of the criticisms that we get, is that companies think that we just don't want them to exist. And, you know, that might be true, but I don't want them to exist tomorrow. I just don't want them to exist in 20 or 30 years. Look, you know, can a company, can Santos or Woodside become an offshore wind company? I don't know. I doubt it. I don't. You know, the appetite's not there, because, you know, we've even put that question straight to the chairman and the CEO, and their response is, well, no, we're a hydrocarbon company and that's what we're good at and that's what we're going to be. Mm-hmm. So I mean, that's the real challenge, right? I mean, I you know, if I knew the answer to that, I probably wouldn't be here. You know, how do you change, particularly oil and gas companies? I think coal companies will probably, you know, coal companies could become a mining company of another sort if they wanted to, right? You could go and mine copper, or you could go and mine, you know, iron ore or something, possibly. But oil and gas companies, there's not really a kind of a straightforward transition to something else. Look, I have to believe that it's possible that, you know, that we can try and change these companies. And the reason we have to believe that is, I get up every day, but super funds still have so much, you know, hundreds of millions of dollars invested in these companies, so they still have so much power. You know, and if they wanted to, you know, they could change the boards tomorrow and put in a whole bunch of people that are prepared to just wind the company up or really transition it into something else.
I think just picking up on that last point is there is sort of the one, I guess, excuse or justification for remaining invested in companies like Santos or Woodside, is if you're going to actually work as an investor to manage that company down over time, make sure it's not investing in new projects, new explorations, and actually, you know, just peter out over time and hand that capital back to shareholders and really manage the impacts on the workers and the sites where the company's operating. So they're rehabilitating sites, they're transitioning workers into new work, things like that. That, I guess, would be where engagement with the company that can't transition should be heading. That's really the only way that you could justify, I guess, engagement with a company that has no place in a low carbon future.
Okay, thanks to both of you for those responses. So another question from Beck. What resources do either of your organizations provide for individuals looking to understand sustainability and ethical performance of ASX listed companies when looking to invest?
Well, yeah, I guess Market Forces resources in this for ASX companies is limited to our out of time report, and that's really geared towards super fund investors and what they should be doing with members' money. But as a resource for retail shareholders to have a look at and understand a little bit more about different companies' approaches to alignment with the Paris goals, then yeah, I think marketforces.org.au/out-of-line should provide some guidance there. But as I said, it's geared towards more the super fund investor level.
All right, Dan?
Yeah, the other, I guess on sustainability more generally, like outside of climate and environment, there's obviously, labour issues and human rights issues and other environmental issues, be it air pollution or water pollution for that matter. In order to do that research, it's really, it's quite time and labour intensive. So, to get that kind of data and research, you've unfortunately got to pay for it. There's a whole bunch of companies like one called Sustainalytics, MSCI, S&P, and to an extent Bloomberg as well, all do kind of research on, sustainability of individual companies. And you can buy sustainability ratings and all that kind of stuff. But because it is so labour intensive, that's a business model for people. So, there's very few orgs other than Market Forces who would chuck up the research online. ACCR just put out a report on labour hire, which is, just looking at, mining companies using or casualising workforces using labour hire. But that's, again, it's really small segments of information rather than, being able to get access to all the information about one particular company. It's one of those things that doesn't come free.
Yeah, for sure. All right, cool. I think I'm gonna do one more question and then we'll wrap it up. So this is a bit of a big one, and it's something that I think we've addressed a bit, but maybe we have some sort of closing thoughts. So from CYJ, at an individual level, divestment from non-ethical organizations implies shifting that investment into more ethical organizations. Many organizations have targets but may not deliver on them. How would you suggest approaching that type of analysis? How do we cut through the noise?
This is a constant challenge for me and others at Market Forces and ACCR as well, and other organisations. I mean, the notion of greenwashing companies or institutions saying that they are committed to climate action, for example, or setting targets or aspirations that really don't ensure that that company is doing anything in the short and medium term to reduce their negative impact on the environment or reduce their contribution to climate change. That's a major issue. It's something that we try as best as possible to call out where greenwashing has taken place and where actions aren't meeting words. But yeah, it's something that I think everyone needs to be wary of. We do what we can at Market Forces, and so do other NGOs and other sort of organisations that apply scrutiny to these types of things. But it's a really tough one. It's a constant battle.
Dan, anything you want to add?
Yeah, I agree. Yeah, I mean, holding companies to their commitments, or super funds for that matter, is that's one of the biggest challenges we've got. You look at someone like BHP, for instance, which got all this media attention in the middle of last year for committing, I think it was like $400 million to carbon capture and storage and reforestation, I should say. And got all these, this applause from the media, but at the same time, it was committing $10 billion to develop new oil and gas fields. So, you kind of got to weigh up these commitments, because often the devil's in the detail. I hate that cliche, but and it's just that constant monitoring. And there's scores of NGOs doing this kind of work. Some NGOs might only focus on one company or one project. And between us and Market Forces, we try and focus on, 50 or 60 companies or hundreds if you Market Forces. But it just takes time and looking at the announcements and kind of digging into them. Unfortunately, we get some investors that are prepared to kind of just applaud, particularly this net zero stuff. Like, we're seeing this flood of net zero by 2050 commitments from companies, which, they're meaningless if they've got no interim targets. If they're not doing anything by 2025 or 2030, then why even bothering? It's just window dressing.
Okay, great.
Sorry to end on a sour note.
That's okay. I think we had plenty of hopeful thoughts throughout the hour. So thank you so much to both of you for participating in this. It was great to get to hear a little bit about your thoughts on all these issues. I did put links to the ACCR and Market Forces website in the chat if people want to look at that. There's many other helpful links in there. Just wanted to remind people that this was presented by Renew Magazine based on my article in this issue. And if you want to get a hold of one of those, you can find it on your newsstands or at our shop, which I will also drop a link to. And if you have further questions that you're looking for Renew to address, you can email us at renewmag@renew.org.au. But yeah, thanks again to Dan and Will. This was great, and have a great day, everyone.
Thanks a lot, Sophie, and thanks to Renew for putting it on.
Yeah, thanks, Sophie, and thanks, Renew. Cheers.
Thanks.